Let's get right to the floor show. Joining me now live, Charles Schwab Managing Director and Chief Investment Strategist Liz Ann Sonders. Well, Liz Ann, on balance, the markets ex today have lately marched higher, no matter what the news. Is that solid earnings this season, good economic data? What do you perceive here?
I think it's decent economic data, but worse than expected. It's not a bad backdrop for equities. I don't think we're at the stage where really bad news would be good news for the market. And then earnings, for the most part, were pretty healthy. So I think that's been a positive backdrop. Today, I'm surprised at such a knee-jerk reaction to, as you pointed out, Liz, what is rearview mirror data, and not just rearview mirror data, but you have to remember that the FOMC meeting that ended on May 1st predated the weaker than expected jobs report for April, as well as the more benign CPI and PPI data. So what they referenced in terms of the kind of pickup of inflation, that eased in data that came in since then. So I'm a little bit surprised. But when you're at all-time highs and you've had such a run on the upside, maybe it's not a surprise to see some profit taking.
Yeah, there was a little spark plug there that jolted people's engines and they skedaddled at something that, again, already happened weeks ago. There have been pieces of data that have come out that have changed things. But one of the things they mentioned in the minutes was that deteriorating household financial positions, especially for lower income households, might prove to be a bigger drag on activity than anticipated. You pair that with Target and the power of the consumer right now to say, I'm done paying these higher prices, especially as we see disinflation. What do you expect really happens here, and how will that affect the markets?
So I think it's not just the lower end, but clearly lower income consumers, especially when they're looking at their wages in real terms, are starting to suffer. And you're not just seeing it in some of the retailers' reports, but you're seeing it in delinquencies in the subprime area, particularly for credit cards as well as auto loans. But you're also seeing a change in buying patterns and habits, even up the income spectrum. So you are starting to see more than just a few cracks in the facade of the consumer. What's also interesting is that consumption in aggregate terms, when a dollar figure is given for how much consumer spending there was, say, last year, which is around $19 trillion, that's not population adjusted. If you population adjust into per capita consumption, it's actually been fairly flat for a couple of years. So the strong consumer, I think, does need to be put in context in terms of that population adjustment. It's maybe not quite as robust as you would think if you were looking at that non-population adjusted number.
Liz Ann, what is the one metric that you are looking for that would, and let's remove today's downward move here. And by the way, the Dow is now pretty well off the lows of the session, still down about 235 points. But what's that one piece of data that you need to see that would make you think, you know what, this very long stock rally might be coming to an end, or at least we see a 10% correction or something?
There's no such thing as one piece of data. That's a silver bullet. I would love if that existed, where I could just look at one piece of data and say, okay, I can now divine what the direction of the market is going to be. These days, breadth conditions, I think, are incredibly important overall for the major indexes, but also at the sector level, some of the underlying leadership shifts that are happening, some of the underlying rotation that is happening. For all the hype and talk about an index like the NASDAQ being at, until notwithstanding today, all-time highs, what a lot of people don't realize is the average member within the NASDAQ, just using that index as an example, has had a maximum drawdown this year of 35%. So there's a lot of churn and rotation going on under the surface that you wouldn't pick up if you were only looking at index level changes. So I think it's that peeling the onion back at least one layer is important to get a sense of truly what's going on in the market.
Yeah, so not one metric, yet the market, or at least much of the market, is hinging so much on the NVIDIA numbers after the bell. Yeah. When you hear about momentum stocks like that, is that almost ridiculous to say, really, you guys are looking at one single stock to move the whole market?
But here's why it's important. Here are the numbers. NVIDIA is now the third largest contributor to overall S&P earnings. It's more than 3%. In terms of the contribution to earnings. Only Apple and Microsoft are larger in terms of earnings contribution, but the level of year-over-year gains for NVIDIA is much higher than any of the other stocks in the Magnificent Seven. And then right now you're looking at about a 24% growth rate for the tech sector for Q1, but you X out NVIDIA and that drops down to 11%. So the math suggests that this is important not just for psychological reasons, but as an underlying support for just the earnings story. So it's important for psychological and math reasons.
For investors listening right now, I know you don't have tech as one of your favorite sectors or one of your stay away from sectors, but what should people be pouring their money into, or at least salting it into? Where is the smart money going? What are you recommending?
So we had the same three outperform ratings at the sector level since the start of this year, and it's materials, financials, and energy. So clearly a cyclical bias in terms of where our work suggests outperform. And then the two sectors on which we have underperformed are REITs, maybe no surprise there given commercial real estate, and also consumer discretionary. And we've already touched on some of the pressures coming down on the consumer, especially as it relates to discretionary type purchases. Everything else would be in that neutral or market perform category.
Finally, anything you see that worries you at the moment? And if so, what is that, Liz Ann?
Sentiment's been interesting. Attitudinal measures of sentiment do come off the boil really quickly. You see a day like today and you see a pretty significant increase in various measures of bearishness, but mostly that's attitudinal measures. If you look at a lot of behavioral measures, whether it's put call, whether it's fund flows, whether it's overall allocation to equities, that's been stickier in the kind of complacent end of the spectrum. So I think that's an interesting spread in this cycle where you get these sort of knee-jerk changes in attitudinal measures of sentiment, but it hasn't really translated into what investors have been doing.
Yeah, we talked yesterday about Bank of America's survey that said the bullishness level is the highest since November of 2021. Liz Ann, great to see you. Thank you so much.
You too. My pleasure.
Liz Ann Sonders of Schwab.